Hi, my name is Pieris Marco, and I would like to welcome you to our third quarterly tax update for 2016, brought to you from the doorsteps of our House of Representatives, where later on today we are expecting two important changes to be voted to our tax legislation, which on the one hand maintain our tax legislation compliant with EU and OECD standards, but at the same time keep Cyprus's competitiveness in attracting foreign investments to the island. What are these new tax changes? Keep watching to find out. As you know, the main aim of our quarterly tax updates is to give you some high-level insights to major tax developments in Cyprus and brief updates on developments around the world that may have an impact on companies operating from Cyprus. In today's webcast, we will look at recent developments in local tax legislation voted and circulars issued during the quarter ended 30 September 2016. We will update you on a new tax treaty signed during the period and briefly cover some international tax developments from the OECD and the European Union. We will close off today's webcast with a quick reminder of the tax deadlines coming up during the next quarter. Let's start by looking at local developments both in tax legislative changes and circulars. Looking first at the changes in legislation, amongst the most important law changes in this quarter include the long-awaited voting of the new IP regime, which follows the Nexus approach, as well as the voting of a new provision for capital allowances on all other non-qualifying intellectual properties. Let's have a look at the details and the other laws voted during the quarter. It is expected that today changes will be introduced to the income tax law, amending the current IP regime and introducing a new IP regime fully compliant with OECD and EU guidelines on taxation of intellectual property income. There will be grandfathering provisions for existing IPs that existed at 1 January 2016 or were developed or acquired from non-related persons by 30th of June 2016, which will be entitled to grandfathering provisions and will continue to benefit from the old IP regime until 30th of June 2021. Intellectual property acquired from related persons and entering the regime between 2nd of January 2016 and 30th of June 2016 will be entitled to grandfathering provisions only until 31 of December 2016. What is qualifying IP? The old IP regime covered a wide range of qualifying IPs, including most intellectual property, copyrights, and trademarks. Under the new IP regime, qualifying assets are limited to patents, copyrighted software programs, and other intangible assets that are non-obvious, useful, and novel. So what are the benefits of the new IP regime? The old IP regime provided for the following income tax exemptions irrespective of the research and development activity performed by the claimant company. 80% of any profit generated from the exploitation of IP and 80% of any capital gains generated from the disposal of the IP. In addition, the old IP regime provided that any capital expenditure incurred for the acquisition or development of the IP could be claimed as a tax-deductible expense in the year in which it was incurred and the immediate 4 following years on a straight line basis. Under the new IP regime, the so-called Nexus approach is used in calculating the 80% income tax exemption on any profit generated from the exploitation of the IP. According to this approach, the tax exemption is provided only on qualifying profits and is calculated based on to the extent of the R&D activities performed by the taxpayer. Details regarding the calculation of the qualifying profits have been published in regulations that accompany the new regime. In addition, under the new IP regime, capital gains from the disposal of the IP are not included in the qualifying profits and are fully exempt from income tax. Now, what is qualifying profits under the new IP regime? The new IP regime provides that 80% of the qualifying profits generated from the qualifying assets is deemed to be a tax-deductible expense. The qualifying profits are calculated in accordance with the following Nexus fraction. It's a qualifying expenditure plus an uplift in the expenditure divided by the overall expenditure on the qualifying asset, all that multiplied with the overall income derived from the qualifying assets, before taking into account any allowance available. The terms are defined in more detail in the regulations. The new IP regime is not only available to Cyprus tax resident taxpayers and Cyprus permanent establishments of non-resident persons, but is also available to foreign PEs of Cypriot tax resident companies which are subject to tax in Cyprus. In order to address this, amending provisions have been introduced in the income tax law to ensure that the taxpayer can elect whether a foreign PE is taxable in Cyprus so that it is classified as a qualifying taxpayer. Persons benefiting from the regime are required to keep track of the income and expenditure of qualifying assets for each of their intangible assets. A further and important amendment is also expected today to be voted in the income tax law, which is the introduction of capital allowances for all intangible assets, excluding goodwill and assets qualifying under the old and the new IP regimes. The capital costs of the assets will be tax deductible as a capital allowance and will be spread over the useful life of the asset as determined by generally accepted accounting principles with a maximum useful life of 20 years. Upon the disposal of such an intangible asset, a balancing statement should be prepared and any balancing addition being subject to income tax and any balancing deduction being tax deductible. The taxpayer has the option not to claim the capital allowances for an intangible asset in a particular tax year. The new law aims to establish and regulate the framework for the repayment of overdue social insurance contributions which are owed by employers up to 31 of July 2016 or self-employed individuals up to the second quarter of 2016. According to the provisions of the new law, taxpayers can eliminate or reduce charges imposed on overdue contributions by settling these contributions either through a one-off payment or through monthly installments. Taxpayers who are interested in benefiting from the new provisions should proceed with an application within the period 1 August 2016 to 30 of November 2016. The application form should be submitted to the Social Insurance Department together with a certificate of emoluments and contributions. The regulation scheme is considered as void if the taxpayer fails to pay any installment for more than 3 months or fails to comply with the current social insurance contribution liabilities. On the 14th of July 2016, amendments were voted to the movable property tax law in connection with the reduction of the movable property tax burden for the tax year 2016 and the complete abolishment of the law as from 2017. With regards to payments for 2016, the law provides as follows. For payments made up to 31 of October 2016, a 75% discount is granted on the immovable property tax. For payments made between 1 November and 31 of December 2016, 72.5% discount is granted on the tax due. Payments up to 31 of December 2016 can be settled via the jccsmart.com process through credit institutions or at the tax department's cashier desk. For payments settled after 31 of December 2016, although the 72.5% discount is provided, an additional 10% charge applies on the tax due, and the payments can only be settled via the tax department's cashier desk. Most importantly, the amendment provides that the immovable property tax will be abolished with effect from 1 January 2017. Finally, on the 25th of July 2016, the Lands and Service Department's Fees and Rights Law was amended, extending indefinitely the current applicable 50% reduction in transfer fees, which was previously in force up to 30th of December 2016. In addition, the law was amended extending indefinitely the current applicable exemption on transfer fees for immovable property transfers attracting VAT. During this quarter, we had 3 important circulars issued which deal with a claim to non-domicile status, the notional interest deduction, and new procedures for obtaining rulings, which has come into effect from 1 October 2016. Let's have a look at the details. On the 28th of June 2016, the tax authorities issued a circular providing details regarding the amendment introduced in the Special Defense Contribution Law exempting from SDC individuals who do not have their domicile in Cyprus. The circular provides guidance as to the documents that the tax authorities may request in determining an individual's domicile. This will include, or could include, the birth certificate of an individual, the birth certificate of the father or the mother, documents providing the place and the period of permanent residence of the parents. In addition, in order to establish the domicile of choice, the authorities may request certificates and documents from foreign tax authorities, employment documents and social insurance contributions, and any other certificates or documents providing residency evidence abroad. In addition, the circular provides that non-domiciled individuals should complete the following forms that can be found on the Tax Department's website. The Form TD624 should be completed by the non-domiciled individual earning income of dividends, interest, and/or rents that may attract SDC. This form notifies the relevant Cyprus organization that it should not be withholding SDC on relevant payments made to a non-domiciled individual. The Form TD38 should be completed by all individuals claiming the non-domiciled status, and it should be submitted to the Tax Department for information purposes. This form should be submitted separately from the individual's personal income tax return at least every 3 years or where there is a change in the circumstances. Finally, the Form TD38 questionnaire should be completed, which provides a list of questions that need to be completed in order for the tax authorities to determine the domicile status of the individual. On the 18th of July 2016, the Tax Department issued a circular providing clarifications regarding the application of Article 9b of the Income Tax Law on the deduction on new equity introduced on 16th of July 2015. According to Article 9b of the Income Tax Law, Cyprus tax resident companies and Cyprus permanent establishments of non-tax resident companies have the right to claim a notional interest deduction on new equity employed in the production of taxable income. As a reminder, the NID is equal to the new equity multiplied by a relevant reference rate, and it is subject to a cap equal to 80% of the taxable profits arising from the new equity. New equity is defined as that introduced by a company as from 1st of January 2015 in the form of paid-up share capital and share premium. The circular clarifies that the following may qualify as new equity: loans payable and other debt instruments converted into issued share capital, shareholders' credit balances converted into issued share capital, non-refundable capital contribution converted into issued share capital, and the realized reserves created after 1 January 2015 converted into issued share capital. The reference rate is the yield of the 10-year government bond as at the 31st of December of the prior tax year of the country where the funds are employed, plus a 3% premium, subject to a minimum rate equal to the yield of the 10-year Cyprus government bond plus a 3% premium. The Tax Department already published on its website the reference rates for selected countries and has expressed its intention to do so on an annual basis. In case where a taxpayer invests in a country for which the yield of the 10-year government bond is not listed on the Tax Department's website, the circular suggests that the yield should be obtained from the reference to Bloomberg. Where Bloomberg is deficient, the circular provides a procedure whereby a taxpayer can confirm the applicable reference rate of any country. The NID is capped at 80% of the taxable profit generated from the new equity and calculated before allowing for the NID. Where a taxpayer invests in new equity in a number of different assets generating taxable income, the circular introduces a scheduling method for the purpose of calculating the applicable NID cap. In this respect, taxpayers would need to be able to allocate new equity between the various assets and activities of the taxpayer, as well as to be able to determine the taxable profits generated from each asset or activity. Finally, on the 16th of August 2016, the Tax Department issued a circular to address the number of issues regarding the process for submitting a ruling request. Following the new EU directive concerning the automatic exchange of information between EU member states, all advanced cross-border rulings must be exchanged. Taking this opportunity, the Tax Department has introduced a new submission procedure. According to this procedure, with effect from 30th of September 2016, all ruling requests must be submitted electronically to the Tax Department and must be supported with the following documents: a completed Form TD 219 and a copy of the administrative fee receipt. The circular provides guidelines with respect to what qualifies as a cross-border ruling and how the Form TD 219 should be completed. One final circular was issued on the 16th of September 2016, which involves the STC exemption of bank interest income received by shipping companies taxed under the tonnage tax system. During the third quarter of this year, we had the long-awaited conclusion of the aid treaty with India and the signing of a new treaty with Jersey. Let's have a look at the details. On the 30th of June 2016, the Cyprus Ministry of Finance announced that the negotiations for the revised tax treaty between Cyprus and India were successfully completed, and the revised treaty is expected to be signed and ratified within the next upcoming months. Following the ratification of the amended treaty, Cyprus will be removed from the list of notified jurisdiction areas, allowing the refund of any tax suffered with retrospective effect as from 1 of November 2013. Under the revised treaty, taxation of capital gains from the disposal of shares will be taxed in the country where the company's shares are sold. Under the grandfathering provisions, the taxing rights on gains arising from any potential disposal of shares acquired prior to 1 April 2017 would remain with the seller's residence state. The revised treaty is expected to revive trade and economic activity between the two countries. On the 11th of July 2016, Cyprus signed a tax treaty with Jersey, a crown dependency of the United Kingdom. According to the tax treaty, the applicable withholding tax rates on dividends, interest, and royalties are maintained at 0%. Although Jersey is not part of the EU, the enforcement of this treaty provides an attractive tax-efficient way for Jersey resident companies to invest into the EU and aims to extend and elevate Cyprus's existing tax treaty network. The provisions of the treaty shall have effect in both countries on or after 1 January following the date the treaty enters into force. For the international tax part of this quarter, we will update you on the developments with the OECD BEPS related discussions and on the EU initiatives, as well as briefly look at the state aid case of Apple. With respect to OECD developments, the OECD has published the comments received from the following discussion drafts on BEPS: branch mismatch structures in accordance with Action 2 of the BEPS Action Plan, approaches to address BEPS involving interest in the banking and insurance sectors in accordance with Action 4 of the BEPS Action Plan, design and operation of the group ratio rules in accordance with Action 4, attribution of profits to permanent establishments in accordance with Action 7, and the revised guideline on profit splits in accordance with Actions 8 and 10, and developments of a multinational instrument to implement the tax treaty-related BEPS measures in accordance with Action 15. Cyprus, among other jurisdictions, has been invited to submit comments on the draft text of the MLI, including the proposed minimum standards on prevention of treaty abuse and MAP. The OECD has also published the comments received on the proposed conforming changes to its transfer pricing guidelines promoted by BEPS Actions 8 to 10 and Action 13. With respect to developments in the European Union, we had the EU Council formally adopting the Anti-Tax Avoidance Directive that was finalized in June 2016. The directive is part of the January 2016 package of EU proposals to strengthen rules against corporate tax avoidance. The package builds on the 2015 OECD recommendations to address BEPS endorsed by the G20 leaders in November 2015. The Anti-Tax Avoidance Directive, though, contains both elements that are derived from the BEPS projects, as well as elements that go beyond that. The EU member states will have to transpose the provisions of the ADAT into their domestic law and generally will be required to apply these as from 1 January 2019, except for the exit taxation rules, which are to be applied from 1 January 2020. In addition, member states with targeted rules that are equally effective to the interest deduction limitation rule may continue to apply these until the earlier of 2024 or the adoption of interest limits as a minimum standard by the OECD members. Let's now have a look at the developments in the new list for non-cooperative tax jurisdictions. The EU Tax Commissioner has released a list of jurisdictions which the European Union will evaluate based on a number of criteria with the aim of releasing the first common EU list by the end of 2017. The new list is part of the EU's campaign to address tax evasion proposed by the European Council in the External Strategy for Effective Taxation back in January 2016 and endorsed by the EU finance ministers in May this year. The common EU list is intended as a last resort tool to deal with third countries refusing to respect tax good governance. In comparison to the planned OECD blacklist for international transparency standards, the EU list will deal with the transparency problems too, but it will also cover a wider range of tax good governance criteria, particularly on fair taxation. Let's close off today's EU developments with the case of Apple. The European Commission concluded that the selective treatment by the Irish tax authorities allowed Apple to pay an effective corporate tax rate of 1% on its European profits in 2013, falling to 0.005% in 2014, which is in contradiction with EU state aid rules. This is illegal under EU state aid rules, and it gave Apple a significant advantage over other businesses that are subject to the same national tax rules. It has been decided that Ireland must recover the unpaid taxes from Apple in the amount of up to 13 billion euros plus interest. Ireland is currently challenging this decision, while the European Parliament has widely supported the decision and several countries expressed their interest in claiming their share of the 13 billion due by Apple at the informal ECOFIN meeting held last month. It is worth noting that in the past, the Dutch government has reportedly recovered 25.7 million euros in back taxes from Starbucks following the European Commission's October 2015 ruling that an agreement to lower the company's taxes constituted illegal state aid. We have two more cases on state aid, and amongst these, the European Commission launched two new investigations into the corporate tax exemption granted by the Belgian and French authorities to ports undertaking commercial operations in their countries. In January, the EU Commission asked both countries to align their taxation of ports with EU state aid rules by abolishing the exemptions, as it is considered that the tax breaks give an unfair advantage to certain ports. Neither Belgium nor France took steps to comply with the Commission's request, so the Commission has opened an in-depth investigation to assess whether the incentives distort competition. We will close off today's webcast with the dates to watch out for during the next quarter ended 31 December 2016. On the 31 of October, we have the deadline for the payment of the immovable property tax with the 75% discount. For the period from 1 of November to 31 of December, we have the deadlines for the payment of the immovable property tax with a 72.5% discount. And on the 31st of December, we have the deadlines for the payment of the second installment of the 2016 provisional tax payment, the payment of the SDC on rents, dividends or interest from sources outside Cyprus for the last 6 months of 2016, the payment of the third installment of the premium tax by insurance companies in the life business for the last 4 months of 2016, and the payment of the fourth installment of the special tax levy by credit institutions for 2016. This concludes our webcast for today. If you have any comments or queries on the items discussed during this webcast, please email us on cyprustaxwebcasts@deloitte.com. Thank you for watching.